Section 1, Cryptocurrency Aims and Properties. So we just talked about blockchain technology. Now, what exactly is this being used for? Well, the idea is that we'd like to use it as an infrastructure for money, or something close to money, or as we'll see a little later, other things. What is money? Well, let's take a moment to define money by way of its classical functions, in the way that we see it with traditional fiat currency. Now, fiat currency is attached to, governments, so strictly speaking, cryptocurrency is not like fiat currency as far as money. Money is a store of value, a medium of exchange, and a unit of account. What makes something a good store of value? It has to be reliably stored, saved, and retrieved. Now, during that time that your money is stored or saved, you'd want it to retain a stable value, therefore allowing retrieval to happen comfortably without realizing losses pretty much whenever. Stores of value are most meaningful when they can also be used as media of exchange once retrieved. What makes something a good medium of exchange? Pretty straightforward. This means that you can use it to acquire goods and services. Adoption is a decent measure of this. The US dollar is at the moment the best medium of exchange in the world, as it's accepted by more businesses than any other currency. What makes something a good unit of account? This one's a bit more involved. A currency should be divisible into smaller units, like dollars can be split into cents or Bitcoin can be split into satoshis, without loss of value. It should be fungible, meaning that 100 cents is equivalent to $1, which is equivalent to 4 quarters, and each of these is nominally equivalent units is interchangeable. And it should be countable. In other words, you should be able to directly perform mathematical operations on it, like subtraction, addition, and multiplication, and so forth. So, taking a look at, again, Bitcoin as our example here, we see that it's really not a widely used medium of exchange at the moment, but it is a reasonable store of value and has the fundamentals required to serve as a unit of account. It is fungible, countable, divisible, and can be used to acquire goods and services as long as the business accepts BTC as payment. More businesses are accepting BTC, but it's not exactly like you can go to Kroger and get your weekly grocery haul in Bitcoin. When it comes to storing value, there are pros and cons. You can store BTC in wallets securely. You can retrieve them and sell them on exchanges for fiat currency. However, how much you can sell at one time successfully will depend on trading volume. That won't commonly be a problem for most people, but for larger institutions with millions of coins, it can be. Another issue with BTC as a store of value is the volatility of its price. One can, and perhaps should, make the argument that BTC has performed very well as a long-term asset, and thus has excellent store of value. But the volatility can make short-term store of value a little iffy. Right now, we're going through a pretty good 50% plus correction in Bitcoin. And for a lot of people, that may make them feel very hesitant about retrieving any of their money, as they feel they'd either be realizing losses or leaving large gains on the table. When we talk about things like crypto tokens and coins, we have to be clear on some terms. BTC is the native token of the Bitcoin blockchain. ETH is the native token of the Ethereum blockchain. DAI, Link, and Mana are tokens that are built on the Ethereum network. These tokens utilize the underlying Ethereum blockchain, but their values are independent of the value of ETH. Now, there's a few more properties of cryptos that you'll want to be familiar with before you wander out into the market to hodl some coins. So why don't we start with something we've already mentioned multiple times: consensus mechanisms. The two major ones to know about are proof of work and proof of stake. In explaining these, we'll touch on the idea of mining and minting, and we'll look into where exactly crypto miners factor into the development of blockchains. If you search around, you'll find systems that are hybrids of these, proof of activity. You'll find proof of assignment, proof of burn, proof of capacity, proof of elapsed time, proof of authority. Forget these, nobody cares. Just kidding, but not really. These are typically used by a lot of smaller altcoins and aren't as important, at least for the time being, to understanding the modern crypto landscape. Let's start with proof of work. Proof of work utilizes miners, which are nodes that participate in verifying new nodes. Each of these nodes, or computers in the network, are doing work in the form of cryptographic computations, energy-intensive puzzles that need increasingly more computer power to solve. These puzzles are what's called asymmetric cryptographic operations, which in this case means they're very hard to solve, but very easy and quick to verify if they've been solved correctly. Almost reminiscent of how you can get a public key from a private key, but not the other way around. These puzzles are energy intensive because they are inherently guess and check in their nature. So therefore, if you want to solve it faster, you need more computational power. The difficulty of these puzzles is dynamic depending on the chain's block time. If miners are solving too quickly, they get harder, and if miners aren't solving fast enough, they get easier. Miners are rewarded for their work, often in the form of the coins they're mining, which is why they participate in the first place. Bitcoin, BTC, Dogecoin, Doge, and currently Ethereum ETH use proof of work. Ethereum will soon transition to proof of stake and use ETH2 as their coin. Proof of work, as the consensus mechanism used by Bitcoin, like I said earlier, is the oldest and most tested at scale consensus mechanism. Next, we have proof of stake. Proof of work wants to achieve security by requiring lots of work and energy to verify a block, therefore imposing a large energy cost toward attacking a blockchain using its own processes. Proof of stake goes more in the direction of game theory, instead requiring nodes to have a stake in the blockchain to participate in what's called minting. Instead of mining and miners that mine new coins, like proof of work, proof of stake uses minters or validators that mint new coins by staking a certain quantity of coins or tokens to verify new blocks. Unlike with proof of work, you can't participate or attack the network without owning part of it. Typically, the process of deciding who gets to mint the next block is random. However, staking more coins typically means a higher probability of being chosen to mint a block. Validators, like miners, are rewarded for their work. Binance BNB, Algorand Algo, Solana Sol, Polkadot's DOT, and Stellar Lumens XLM are examples of coins that use proof of stake. There's variants of these like delegated proof of stake and pure proof of stake used by EOS and Algorand. Now let's talk about layers. As you venture out into the crypto space, you're going to hear a lot about layer 1 and layer 2, and you might even hear about more layers. Cryptocurrencies, like ogres and onions, have layers. We don't necessarily have a universal agreement on how many layers there are, but we mostly know what people mean when they talk about layers 1 and 2. Some people say that the hardware used for blockchains should be considered layer 0. Some put decentralized applications, or dApps, in their own layer. There's more than one way of conceptualizing the concept of crypto layers. Most of what we just spent a bunch of time describing, blockchain setups, consensus mechanisms, is what people refer to as layer 1. What we've covered gives you a decent understanding of mainstream cryptos like BTC and ETH, but there's a lot more you can do in layer 1. Basic Attention Tokens Layer 1 is built around a browser called Brave, and its coins are set up around catering to advertisers and content creators. Algorand's Layer 1 is very focused on large-scale decentralized finance. Decentraland is literally an augmented reality video game with a browser version that houses NFTs that can be bought and sold with their Mana token. When you go to a cryptocurrency's website, read their mission statement, and go through how they address that mission, for the most part, you're basically reading about their Layer 1 strategy. Layer 2 pretty much describes any framework or protocol that overlies Layer 1. That's a pretty vague concept, so let's flesh it out. Layer 2 solutions are typically meant to address scaling and speed issues that Layer 1 might run into. Remember when we were talking about scalability difficulties and how Bitcoin can only handle 7 TPS? There's a Layer 2 solution called Lightning Network that's trying to address this by using something called state channels to allow users to transact off-chain, and then the Lightning Network reports that to the Bitcoin blockchain. This way, you don't have to change the Layer 1 blockchain, which would be prohibitively difficult, but you can still speed up transactions by moving them off-chain. Since the data is added to Layer 1 using the usual mechanisms, security is preserved. Raiden Network does something similar for Ethereum, but it sounds cooler, so it's better. Anyway, the identity of a cryptocurrency is in large part related to the specifics of how its blockchain is set up, which consensus mechanism it uses, and its use cases. I wouldn't by any means call this a comprehensive overview, but it's a decent start. Section 2, some cryptos and why they might show promise. Okay, so this is the part where I shill some coins. Mind you, I do this strictly to provide educational examples about how some of these concepts apply in the real world. Not because I own these coins. I mean, I do own all of them, but don't think too hard about that. What we're going to see here is that a lot of projects aren't strictly what you would call cryptocurrency, as being used as currency isn't necessarily the primary goal, necessarily. That's more what Bitcoin is doing. Others kind of have this as an ancillary feature, but that's not their real focus. The point of choosing the 3 coins we're going to go over in this section is to cover a variety of applications of blockchain technology to really give you an idea of what's possible in the modern crypto space. What's not the point of this section is to give a comprehensive overview of these 3 coins, only the basics so that you can understand what they're trying to do. If you'd like individual breakdowns of some coins, feel free to comment down below and I can do that. Anyway, here we go. Let's do Bitcoin first, as we've kind of already made a good basic description of Bitcoin already. This is the coin that coined, pardon the pun, the idea of cryptocurrency and established one of the blockchain's earliest use cases as a potential replacement for fiat currency. Its layer 1 is a proof-of-work blockchain whose native coin, BTC, has a capped supply of 21 million. This means that there will never be more than 21 million BTC in circulation, and more BTC are added via mining rewards. At the moment, it functions mostly as a store of value, but it's making inroads with companies that are starting to accept it as payment, giving it the most use out of pretty much every crypto as a medium of exchange. There's actually a surprising number of companies that do accept BTC. PayPal, Microsoft, Tesla, some food chains like Burger King, Venezuela, Pizza Hut, Venezuela, I wonder why Venezuela, are just a few examples. Actually, scratch Tesla as of right now. Bitcoin is the oldest and most well-known cryptocurrency and thus has the most public engagement and institutional demand. Grayscale has a Bitcoin trust. Cathie Wood's ARK Investments own a crap ton of BTC, as does Chamath Palihapitiya's Social Capital. Bitcoin is in the news pretty much every day now. About 17% of Americans now own at least a few Satoshis. Upcoming Layer 2 scaling solutions include Lightning Network. You can't pay taxes, except in Switzerland, or take out loans in BTC. So it's not quite like real money just yet, but who knows how that'll go in the future. So far, its all-time high is in the 60K range, but bulls like Cathie Wood think 500,000 is a realistic future price point in the next few years. Next, we have Ethereum. Ethereum is a whole different beast from Bitcoin, which is why it's frustrating that its price correlates so closely with Bitcoin's. Ethereum has some of the basic features that Bitcoin has. It runs on a blockchain. It has a native token, or coin in this case, which is called ETH, and Ethereum is the overlying platform. Kind of like BTC is the coin for Bitcoin, and Bitcoin is the overlying platform. It can serve as a store of value. It has solid social engagement, what with its second highest market cap and broad business exposure. It has potential as a medium of exchange. It's currently proof of work. However, ETH2 will be proof of stake. But honestly, past that we go immediately into differences. It does not have a fixed supply. Most importantly, Ethereum, the platform, has a feature that pretty much defines it as a second-generation cryptocurrency. Smart contracts and the possibility of Layer 1 decentralized applications, or dApps, that run through what's called the Ethereum virtual machine. This is a big deal. Bitcoin is a store of value with a decade of economic proof. Ether has that, and you can also make programs that run directly on Layer 1. In other words, the code, once written in either Solidity or Viper programming languages, reside on the blockchain and are executed by the Ethereum virtual machine independent of human control. If you think about it, this is, at its base, a way of potentially replacing the entire digital economy as we know it. every single Amazon transaction could theoretically work as a smart contract on Ethereum. Legal contracts could be enforced by smart contracts. International banking could be facilitated by smart contracts. If Generation 1 was essentially proof of concept for blockchains and crypto as a store of value, Generation 2 is proof that we don't need much other than blockchains and crypto for any individual thing. In order to deploy smart contracts, execute them, and do transactions, users of the platform currently have to pay gas fees to miners to add their data to the blockchain. They can pay a premium to speed this up, which by the way is measured in seconds as opposed to Bitcoin's 10-minute block time. As of right now, it has an unlimited monetary policy, like I was saying, with its new Ether being mined without a cap. Businesses accepting Ether as payment include Shopify, Overstock, Cheap Air, and some more. Generally less than BTC at the moment. Layer 2 solutions include Raiden Network and Polygon, which we'll talk about next. Ether's all-time high is almost $4,400. There's a variety of bull cases for Ether based on who you agree with and what your research tells you. Some think 10K ETH is practically guaranteed in 2021. Others think 10K ETH is still a year or two off. Goldman Sachs recently had a leaked internal document saying that they expect the flippening, the moment of Ethereum's market cap surpassing Bitcoin's for that number one spot, is highly likely within the next few years. Now, note that this means by market cap, not necessarily that the price of an individual Ether will surpass the price of an individual BTC. Now, that all sounds really, really good. But at this point, ETH has run into a bit of a scalability problem. With the network at its current size, with so much data being added to the blockchain, gas fees have gone up to remarkable levels. It becomes progressively less cost-effective to use the platform. The Ethereum Foundation's answer to this issue is a hard fork, making ETH into ETH2 and making a bevy of large changes to how the platform works. For one, they're going to go proof of stake, which should drastically reduce energy costs, as work or energy will be required nearly as much to validate new blocks. They're also switching to sharding with the beacon chain. In other words, they'll be running multiple chains in parallel to reduce hardware requirements and increase TPS. They're also switching to a system where validators get a block reward, and a certain amount of gas will be burned or destroyed and removed from supply, which will decrease supply and make ETH2, if not deflationary, at least disinflationary. If you're interested in looking a little further into the business exposure and stuff like that with ETH, I would go look into the Ethereum Enterprise Association and look at which companies are kind of involved in that. There's actually a bunch of investment banks, and all of Microsoft Azure runs with Ethereum. There's actually a surprising amount of exposure and momentum when it comes to Ethereum at this point. While we're talking about coins and why they're valuable, let's take a moment to talk about Metcalfe's law, an idea from computer science that's typically applied to networks like Facebook, but with the advent of cryptocurrency, has seen rising application in economics toward models of valuing cryptocurrencies like Bitcoin. One fundamental problem some people have with cryptocurrencies is that we don't really have as many hard rules and metrics for valuing crypto that we have for like stocks or real estate, which is a fair point. Nobody really has a definitive answer on how best to value cryptos. Metcalfe's law is one potential solution, as it states that a network's value is directly proportional to the square of the number of users in the network. Its application in crypto valuation importantly takes into account that despite the supply being fixed in the short term, especially with BTC with its hard supply cap, demand is not the only factor that affects price, as the simple addition of new users is valuable to the network. Any model for crypto valuation should account for both coin supply and creation and user/wallet number. A more holistic approach for now is probably better, as we'll detail in part 3. For more on Metcalfe's law and a more technical analysis of why it works, see the link in the description. Polygon is a sidechain solution to the scalability problem of Ethereum that also aims to connect it to other blockchains. Founded in India and initially called Matic, Polygon allows multiple blockchains to interact with Ethereum while maintaining their own sovereignty. The native token is still called Matic. Everything running through Polygon is finalized on the Ethereum blockchain, but consensus is achieved via proof of stake. Polygon supports the Ethereum virtual machine and allows users to leverage smart contracts. Polygon is essentially a scalability solution that's agnostic of Layer 1. However, it was built off a solution that was written about by Ethereum founder Vitaly however the fuck you say that, and Joseph Poon, who's known for his work on BTC's Lightning Network. That's called Plasma, and improved by the Polygon's founders from a form called More Viable Plasma to what they now called Matic Plasma. The basic idea is that you can use side chains, called child chains, or in Polygon Plasma, commit chains, that have their own blockchain data that are confirmed en masse off the Ethereum main chain before being uploaded all at once to Ethereum. Polygon is trying to branch out as much as possible to other blockchains at this point. As for monetary policy, its Matic token is capped at 10 billion maximum supply. Joseph Poon. Basic Attention Token is a blockchain network built on Ethereum whose native token is called BAT. What's really cool about this one is that the project is centered around a web browser called the Brave browser. The whole system is based around the monetization of user attention while also addressing issues of user privacy and data ownership. By using blockchain technology, the way users interact with advertising can be tracked, allowing for fewer and more targeted ads, the focus there being meant to be fewer. The browser itself automatically blocks invasive cookies, malware, and trackers. You can earn BAT by using the browser to view ads, but only if you choose to, and content creators can benefit from BAT tips if they sign on as a verified creator. It's a relatively new browser, but it's already shown to be faster than every major browser people are using. The browser is built to protect your privacy, unlike other browsers that actively record your information. Even their private mode is more private than other browsers' private modes. The price of BAT, interestingly, is pegged intrinsically to ETH, 1 ETH being 6,400 BAT. So if you're bullish on ETH, you're bullish on BAT, inherently. For a network based on attention, it has ironically low social engagement. But its system of expanding institutional demand by offering increased return on advertisements is gaining traction as organizations like the LA Times, NPR, the Home Depot, Verizon, and thousands more have launched ad campaigns on the network. Brave browser's active user count has surpassed 25 million at this point and seems to be growing pretty steadily. So that's a few examples of the applications of blockchain technology. But honestly, that's only just scratching the surface. OVR is a coin that's used to purchase virtual land in an augmented reality platform called Overland. Mana is a token built on Ethereum used to buy virtual reality property and buy and sell NFTs. ICP is the token for Internet Computer, which is basically trying to reinvent the internet entirely. Some tokens are governance tokens, others are utility tokens, or transactional tokens, or platform tokens. Each of these have their own intended purposes. If you'd like to see concentrated videos about any of these coins, including BTC or ETH or Matic, which we've only touched the surfaces of, please let me know in the comments below. Section 3, Attacking Crypto Blockchains. Now, you might be wondering, with all this techno-babble going on and this whole thing being on computers and the internet, there must be technical vulnerabilities, right? What can bad actors do to take advantage of weaknesses in blockchains, and why should I care? Let's answer that last one first. There's a variety of weak points where the assets in a cryptocurrency can be attacked, and one of those weak points is you, as we'll discuss soon. At the very least, if you're going to get into trading cryptocurrencies, you have to know at least enough not to be the weakness that makes the money in your wallet disappear. What we're about to go over isn't going to be a comprehensive or even particularly detailed overview of how cryptos get attacked, but it'll be a place to start. Most of it won't apply to you in your everyday trading, but the part about making yourself less hackable will. Let's first go over ways of attacking the blockchain network itself. We'll start with DDoS attacks, or distributed denial of service. We're talking here about people who use multiple connected devices to overload a network with fake or frivolous traffic, making it essentially unusable for its normal functions. This is pretty hard to do to an actual blockchain, so historically these are aimed at websites like crypto exchanges. Bitfinex and OKX have been attacked this way before. This would essentially make it impossible to trade cryptos, potentially leaving people with serious losses during a bear market. More importantly, it might shake investor confidence in the attack networks, leading to a potential drop in use of said network. There's also transaction malleability attacks. Bitcoin transactions, for example, are assigned transaction IDs by hashing their contents. You can manipulate certain types of information that go into the signature hashes in order to draw money from the paying account, but make it appear to them that it hasn't gone through. The receiver still gets their money, but the idea is that the sender can be tricked into spending twice. The first large-scale example of this being used was the exchange Mt. Gox with BTC, and Mt. Gox actually had to file for bankruptcy as a result. Sybil attacks are named after Sybil Dorset, a patient with dissociative identity disorder. They typically involve taking over or creating multiple dishonest nodes in a blockchain network, and in the context of blockchain, these often take the form of 51% attacks, wherein a hacker controls 51% of hashing power and can therefore do pretty much whatever they want with the blockchain. So-called long-range attacks can be used to attack proof-of-stake networks by stealing or purchasing private keys with access to lots of coins, and a good history of minting/validating that can be used to create alternative blockchain history and gain more rewards that way. Now, let's talk about how people attack user wallets. This type of attack is pervasive, and you'll need to be on the lookout for these. Blockchains, as described in Part 1, are a pretty secure technology. You, however, are a flesh and blood fallible person, and as such, you are oftentimes the weak link in the network. A lot of everyday blockchain attacks are attacks on the users, not the blockchain. This is done by more mundane means like phishing, and by more involved means like hacking cold wallets. Phishing is a pretty well-known term at this point. An attacker tries to get sensitive information on you by literally just asking you to input it on a website or something that on its surface seems legit. This may literally be one of these emails you get where you've been selected to receive free coins, or that you've randomly won a prize and all you have to do is log into your wallet with the link below. Naturally, the link below does not go to the standard login page, and you're just giving them your info. Please don't do this, guys. You didn't randomly win free money. Do not pass go. Do not collect $200. IotaSeed.io got taken down in 2018 by a phishing campaign that stole over $4 million in IOTA from users. Dictionary attacks are where hackers basically go through the dictionary and try disappointingly common, simple passwords like password. For the love of God, don't make your wallet password or something stupid like that. And if one of your previous passwords has been compromised online, which various services allow you to see, try not to use a variation of that. A simple way of generating a memorable password that can still be strong is to basically take a phrase like, Stacy's mom has got it going on, and then just pepper that with numbers and special characters like %, $, etc., whatever. If a website allows you to use 8 to 16 characters, use 16 characters. Avoid using full words and or special characters. You can remember the skeleton of the string because it's from a common language phrase, but you can make it secure against dictionary attacks by replacing letters with other characters. Shout out to Edward Snowden for this one. These are the main user-side attacks that you can potentially defend against. Other attacks, like cold/hot wallet attacks, taking advantage of vulnerable signatures or flawed key generation code, are a bit more technical and can be difficult or even impossible to defend against yourself. They're rarer, but sometimes you're just crossing your fingers, like you're doing anytime you put your sensitive information on a website or you make a private password. All you can do on your end is make a strong password and keep it safe. The rest is on other people. The next broad category of attacks is smart contract attacks. These are typically carried out by exploiting vulnerabilities in smart contract code or in virtual machines that run that code. All of these are pretty darn technical and beyond the scope of this video. There's also transaction verification attacks, which generally stem from exploiting the delay in verifying a transaction, which in a blockchain requires a consensus of multiple other nodes, either mining or minting. The goal is often to have the same coin spent twice, reintroducing that double spending problem Satoshi was talking about in the Bitcoin white paper. A race attack, for instance, is where an attacker creates two transactions that rip off one party. The first transaction is a typical payment for service or a good or something like that. If things go according to plan, the receiver will act before waiting for full confirmation, then sends a product or something. The second transaction basically returns the money to the attacker and invalidates the first one. Then finally, there's mining pool attacks. So with the current intensity of Bitcoin mining, it's really hard for an individual with a single machine to make much profit, which necessitates large groups of people joining their hashing power into a pool that shares the load and the resultant rewards. By taking control of these pools, attackers can do things like selfish mining/block withholding, and variations like forking after withholding. Selfish mining is where attackers use pools, mining or minting power, to mine blocks that they don't broadcast to the network for a period before releasing several blocks at once, which causes other miners to lose their blocks. And there you go. That's pretty much all I have to say about vulnerabilities. You'll want to look elsewhere if you want a more technical look at them.